Well, welcome back, ladies and gentlemen. Now, for our next panel discussion, we will ask, where does digitalization of asset management go from here? We'll compare the culture of different fintech hubs in Europe and Asia, look at the key drivers of digital asset management, focus on some key digitalization initiatives, hopefully examine the relationship between banks, fintechs, and asset managers, and also run through some latest regulatory initiatives if we have time, while also trying to answer some of your questions from the audience. So please share your thoughts and queries with us, ladies and gentlemen, in the chat box. Without further ado, I would like to introduce today's panelists, all three highly innovative characters I have had the pleasure of interviewing before in their home environments, and I'm delighted to welcome them to our virtual arena. Firstly, Sharmil Patwa, founder of the Opus Una consultancy with more than 20 years in the financial services industry in transformation roles at Barclays Wealth, Deutsche Bank, and Accenture. Great to see you, Sharmil.
Hi, Yuri. Thanks for having me.
You are very welcome, Sharmil. Next, Nasir Zubairi, CEO of the Luxembourg House of Financial Technology, also a 20-year-plus financial services veteran, schooled in the hectic interbank FX cauldron before setting up an algorithmic desk that traded $10 billion a day. Welcome, Nasir.
Hi, Yuri. Thanks for having us.
You are welcome. And last but not least, Sharmila Whelan, Deputy Chief Economist of Hong Kong-based Aletheia Capital Research Group, serving Asia's leading asset managers, previously regional Asia-Pacific economist at Bank of America Merrill Lynch and regional economist for BP in both Hong Kong and London. Hello again, Sharmila.
Thank you, Yuri. Delighted to be here.
If I can start with Sharmil. Sharmil, you grew up in London, a great city whose future as a financial services hub is now under a cloud, as the mechanics of financial services distribution are not dealt with in Boris Johnson's somewhere there with the EU. Do you feel that your hometown is now seriously disadvantaged in its disconnection from the EU and the ability to attract the best talent for both financial services and fintech after Brexit?
Yeah, so thank you, Yuri. As first, some positive perspective and, perhaps lemons from lemonade. So while our exit from the European Union, which, by the way, I'm very much against, has definite implications in terms of the free movement of labour, I think the pandemic has shown that one's physical location is now of far less significance than it ever was. Also, if everybody's now on the same points-based system, no matter where they hail from, I guess another positive spin on this is that perhaps the bar for talent has just been set higher. On the other hand, London is definitely perceived to be less appealing.
Yeah.
In the eyes of many, the market has just shrunk massively due to our loss of equivalence, and it's still not clear what will be done, and that's a dangerous position to be in, and we need the regulators to be practical, and we need the regulators not to be political. Another consideration is investment. I think there's a real possibility that for some investors, there'll be less interest in some of the London-based fintechs, because of a view of a perceived diminished market. So where founders don't feel that London is the best market to set up in because of worries around attracting necessary investment, this may also become problematic. But I think it's too early to see the signs of this yet. So I think overall, London remains preeminent. It's still a great place to be. We remain a global financial centre. We've got some of the best universities teaching relevant subjects. And so far, we have experienced less of the predicted talent drain than was perhaps anticipated.
So reasonably positive with a few warning signs there, particularly over equivalence. If I can bring in Nasir for the Luxembourg perspective. I know you divide your time between Luxembourg and London, so you can give us a overview. Your Luxembourg House of Financial Technology, with its acronym of the Loft, it evokes the notion of these scrawny, light-starved techno nerds working away to realize an obscure, groundbreaking blueprint. But when I visited your headquarters in the Grand Duchy, it all seemed pretty tame compared to the London trading rooms where you earned your spurs as a self-styled flash boy in the 90s. Can we take Luxembourg seriously as an innovative fintech hub when it all seems so quiet and sleepy?
Hi, Yuri. Take it seriously. I'm not quite sure what that means. I mean, our purpose here is really to develop and drive innovation and digitalization within financial services for Luxembourg. And now increasingly since Brexit, Luxembourg now has to take a leading role in driving that innovation and digitalization across Europe. And that's where our focus is. I mean, the idea of sort of a bunch of techno nerds coming up with solutions for financial services, I think, is just imagery that maybe the media likes to spin. I mean, fintech, which is a word I have to admit I personally hate, has been around for decades. You know, financial services and institutions have been using technology as the backbone of their institutions, you know, for as long as I can remember working in banking, and even way before that. So, I mean, we just have to look at the proactivity of developing new solutions, the creativity of a whole bunch of new firms that are coming to market, trying to not necessarily, again, another word I hate, disruption, but actually looking to work with the traditional sector, which is our core focus here in Luxembourg, to essentially enhance the customer experience, but also to help those institutions to continue to thrive and survive. The EU as a whole, in terms of financial institutions, specifically the banks, which also included, by the way, metrics for the UK banking industry, the last data I have, is the worst performing in the world aside from Japan. You're talking of less than 6% return on equity, less than 2% return on tangible equity. That also obviously impacts the fund sectors. A lot of these institutions are administrators and asset servicers. So, you know, technology is desperately needed in this area in order to drive productivity and ensure its future survival. And that's where a lot of the focus is. We've now got around 250 firms that have their bases in Luxembourg, amongst which are some of the largest institutions in the world that use Luxembourg as their European headquarters, the likes of PayPal, the likes of Amazon Web Services, Rakuten Bank are based here as well with their digital offering, and many more are coming. What they find here is, firstly and predominantly, I think, the value of an English-speaking base within the center of the European Union. I don't speak any French or German, and I've lived here now for 5 years quite happily. A very international, diverse, and skilled talent group in financial services, but also very easy access to a very broad customer base. As you well know, Luxembourg is the second largest fund center in the world after the US, with 5 trillion in assets. So we have all the institutions here in a country of 600,000 people. Everyone gets to know everyone, and the accessibility and sales cycle for a technology firm to get access to these institutions is relatively short compared to other centers. So yes, we are developing a center here. I'm not looking to compete, or we're not looking to compete with anyone else. I'm not looking to be number one. In fact, we collaborate with all other centers across Europe to try and move forward digital within the financial services arena.
Thank you, Nasir. And we will come back later to that collaboration, particularly between the technology companies and the asset managers. But if I can bring in Sharmila, you have spent much of your career in Hong Kong, where we have recently seen arrests of those dissenting against the demise of China's one country, two systems policy. Is this the end for Hong Kong now as an outward-looking financial capital with global resonance, or do you expect Hong Kong against the odds to prosper in digital innovation for asset management, perhaps as the key financial hub for the Greater Bay Area?
The short answer is no, this is not the end of Hong Kong. Hong Kong has not been abandoned, quite the contrary. China needs Hong Kong and Hong Kong needs China. Hong Kong is an integral part of China's Greater Bay Initiative and the Belt and Road Initiative programs, which, as you know, is about securing China's economic prosperity going forward. Hong Kong in the 13th five-year plan was identified as playing a major role in terms of being the international center for not only finance, legal, dispute settlement, but for trade as well, but mostly financial, for all the lending at business, for R&B internationalization. And, Hong Kong is well placed, right? If you look at Hong Kong, there are more than 600 fintech companies. 86% of traditional banking is already adopting fintech. You look at the fintech companies, 56% of their founders are from the mainland, so the connections are close. And you can see the whole investment, digitalization of investment between China and Hong Kong. And I think it first started in 2016 with the establishment of the Shenzhen Hong Kong Stock Connect. Then in 2017, we had the Bond Connect. And then last year, China's announced that they're starting the pilot scheme they announced this in June last year for creating the Wealth Management Connect, which would allow residents in Hong Kong and the residents in the cities of the Greater Bay Area to invest in wealth management products offered by banks on both sides. And you can see the numbers, right? If you look at the Shenzhen Hong Kong Stock Connect, in terms of turnover, since its establishment, it's increased ninefold, and the number of trades have increased 11-fold. Last year, or even January this year, the daily turnover on the Stock Connect is around 200 billion. So, Hong Kong is an integral part, and it's already very much there, and it's only going to grow.
Is there a suggestion in what you're saying, Sharmila, that the Chinese authorities, through the Greater Bay Area, through their dual circulation policy, they will now concentrate on building financial infrastructure in China, in that region there, rather than building financial infrastructure through the BRI initiative globally, that their financial services priorities are now more internal?
I would tend to agree with that. I think the GBA is taking precedence over BRI, because remember, the GBI is all about accelerating the development of the Greater Bay Area to make and basically making it the hub for high-tech manufacturing and the modern services industry, basically China's Industrial Revolution 4.0, and the whole purpose of that and the dual circulation framework policy is to reduce China's dependence on foreign technology. And again, in this context, Hong Kong is really important because Hong Kong, because of it's an international center for finance, legally better protection of shareholder values, the rule of law. Hong Kong is seen as serving as the connector, right, as the beach connection between foreign technology companies and investors, international investors.
Thank you. Well, as well as this Hong Kong Stock Connect, a major initiative, let's look at some other key digitalization initiatives in various territories. Sharmil, Patwa, rather than trying to automate the entire asset management process, should we instead split it up into its constituent parts and decide which are better done in person and which are digitized?
Yeah, I think this depends on needs. If you're a client that just requires an execution-only service. There are loads of online stockbrokers out there, and your whole experience can be digital, and you will never need to engage with a human. That's been available for a long time. If you're a client that wants a relatively cheap, fully digitalized discretionary service, well, then that's robo-advisor generation 1. Again, no need to talk to a human, and that's been available for some time. If you're a client that wants a fully digital advisory service, on the other hand, then that's not there right now. Could you build the technology? Probably. Should you build the technology right now? I don't think the market's ready for that right now, and the costs would probably be prohibitive relative to the income that can be generated, just given the types of clients that engage with that type of proposition. Moreover, when people take any form of expensive advice, be it financial or be it legal or be it accountancy, there is an expectation of human involvement, which may be irrational, actually. So, and then in terms of deconstructing the process, yeah, absolutely. In terms of deliberating which parts of the process can be automated, absolutely. In terms of determining which are better in person, yes. And as time goes, I think the parts of the process that are related to or dependent on empathy or sympathy or more generally the ability to relate to the client, those are the ones that will tend to be the analog processes that remain. And this is kind of, we've got artificial intelligence now. We don't have artificial emotion. I think if you want to automate everything, then you need that too.
And there are some digitalization trends which can be truly transformative. I'd like to bring in Nasir. We have seen virtual currencies back in the news with Tesla's 1.5 billion purchases of Bitcoin. Will tokenized new assets using blockchain registers for previously untradable holdings, will these lead to an investment revolution, perhaps similar to that one of the early 1990s, when asset management firms began to offer access to emerging markets through UCITS, which retail investors could not previously buy into? And how is Luxembourg positioned for such a potential revolution?
Short answer, Yuri, is yes, there will be a revolution. I need to put this in context because I think sometimes when the traditional industry are listening to someone like me, they tend to just laugh and believe that nothing is happening. You gave some of my background, and just to clarify, I am not a technologist in any way, shape or form. I spent most of my time working in capital markets, in financial institutions. I have not been a huge believer in blockchain technology. I believe that this is a technology looking for a problem to solve, and in fact can argue with most people that I can solve problems better with normal client-server traditional infrastructure. Why do I need blockchain? However, I came to the conclusion about the end of 2019 that the momentum here is just going in one direction. It's unstoppable. It's an unstoppable force right now. And as we've seen over the past year, the increasing attention that even governments are giving, and ECB is giving specifically to central bank digital currencies, to the enhanced use of blockchain. The data I've seen recently from some high-profile fund managers is that they estimate, based upon survey data, that around 36% of asset managers are in some way, shape or form either directly on a proprietary basis or indirectly holding positions on behalf of their clients, invested in some sort of token-based asset, be it a cryptocurrency or some other token. And the estimate is that within the next year, that will increase to 57%. Tesla putting in money is obviously very interesting, but you need to look at the big fund managers and asset managers and investors that have been throwing money into the back of this. Druckenmiller has put huge amounts behind this, and a number of other large investors are beginning to invest in crypto. As I said, this is happening, and we can't do anything to stop it, nor, I think, should we, given that there are a variety of efficiencies and added pieces of added value that can be derived from this, particularly in providing access to other alternative asset classes in a world where today we have very limited choice, and the realities of the stock markets, particularly in the US, are not really reflective of the real economy. The correlations are obscure right now, and something bad is going to happen eventually. So having a broader portfolio, a broader plethora of assets to be able to invest in, which can be driven through tokenization due to the lower issuing costs, should be very attractive to a whole range of investment managers, but more importantly, is attractive to a whole range of clients. So the industry really needs to get its act together and forward to adopt the technologies and processes to be able to utilize this technology.
So very positive digitalization perspective from Nasir there. And if I can bring in Sharmila, if we look at the growth sectors in Asia, including digital payments, we've seen both state and industry initiatives in the digitalization of the renminbi, which was discussed earlier today, and cross-border investments. There's the huge Chinese players such as eFund raising billions electronically, and online wealth management, to name a few. The key recent Asian digitalization stories in financial services which really stand out for you.
Well, as you said, Yuri, I mean, e-payments is the biggest one, right? And, you look at China, for instance, right? Last year, already, by 2017, it was 40% of the global e-commerce transaction it accounted for. Last year, mobile payments reached 80 trillion, of which about 12 trillion was processed through fintech companies. Now, so that whole consumer-led digitalization story in China continues. But I think as the next stage in China, you're also going to see much more digitalization and use of ICT in the production side, right? And the other growth area that's going to continue to pick up is e-lending. When you move to, say, India, in India, e-payments accounts for about 1/3 of fintech, right? And at the moment, mobile payments are running at about mobile phone payments are running at about 100 billion per month. But the area that is growing the fastest, again, is lending through fintech companies, and that's a trend that you're seeing replicated also in Southeast Asia. So if you look at Southeast Asia, you saw tremendous growth last year of the whole digital economy simply because of COVID-19. So if you look at e-payments, it reached 650 billion. Remittances increased twofold. Online selling of insurance rose by 30%. But going forward, where I think you're seeing the growth is expected and it's already happening, is really on the lending side. And understandably, just to finish off, you take Southeast Asia, 80% of SMEs don't have access to affordable credit and are unbanked.
I think that brings us in very neatly to the collaboration between banks, asset managers, and fintechs. And if I can stay with you, Sharmila, the Chinese market, which you've been talking about, is a live and fascinating case study in the rivalry between banks and the government on one side, often state-owned banks, and asset managers and big tech platforms branching into financial services in the other. Who will win from this competition in Asia? I know Nasir doesn't like talking about winners, but the big banks and authorities, will they have the overall upper hand, or the big techs and fund managers, or will they need to collaborate in order to coexist?
I mean, Yuri, that's a great question, especially right now where, China's come back with its anti-monopoly law, which they've put together in a matter of 3 months. And, the implications of that are still to be seen, especially for someone like the Ant Group. Um, and this is a personal view, but, I think, the three key virtual banks, the online banks, which is WeBank, MyBank, and XW Bank in China, they are servicing the SME sector, right? 80% of their borrowers, especially in the SME sectors, have got no credit history. They've, WeBank, for instance, they facilitated nearly 500. They facilitate 500 million unsecured loans, and most of them are short term. And the loans made by the online banks, they're short term. They're mostly for working capital, and they're small amounts. So far, they've been playing a complementary role to the traditional banks, for whom they just can't access this market because the profitability, the cost, etc., etc. So I can see that rule continuing, right? That you got the traditional banks and you got the online banks who are already regulated, and then you're going to see a plethora of tech companies that are providing technological solutions to financial institutions, right? Question is, what happens to the fintech kind of companies like the Ant Group, Tencent, those guys, right? Because so far, what you've seen is that with the growth of e-commerce, the traditional banks have just become payment channels or the back office to these tech giants, right? I think what you're going to see is what we're already seeing. They're coming increasingly getting coming under the regulatory umbrella, which has been long overdue in my personal view. But I think you will see Tencent and Group, them increasingly selling financial products on their platforms, right? I think the wild card is the electronic digital currency that PBOC is going to introduce, and what the implications of that is going to be for the payments fintech companies. But I'll stop there.
Thank you for that summary, Sharmila. I'm going to bring in Nasir on this same topic, the collaboration, because Luxembourg, as you mentioned earlier, it has the advantage of a long developed financial services industry, one of the largest in the world in terms of funds, as well as this fast increasing community of tech entrepreneurs. I've met some of these entrepreneurs. It maybe was 5 years ago, but when I met a group of them then, they said, we've come here because we like the place, we like the regulations, we like the infrastructure. Do you talk to the fund manager? No, they said, we may do in the future. This is what I want to ask you. Do the two communities exist in separate bubbles, or have you been able to come together into a mutually beneficial and innovative ecosystem?
Yeah, I mean that's key to what has built the community here, Yuri, is this gelling of an ecosystem. We do have the benefit, obviously, in Luxembourg of being a small community. As I said earlier, I love the fact that everyone knows everyone. We run a variety of events, and I can get the chairman of a bank dropping in, fund managers, lawyers, regulators, Minister of Finance, Minister of Economy. I've had all these guys just literally drop in for social drinks or social events pre-COVID. And we hope that will resume sooner rather than later as well. So you get access to people here and a community. And the criticality here is that what I found very interesting when I first came to Luxembourg, talking to senior execs here, firstly is that 50% of the population are foreigners. That's even greater within the financial services industry. I think it's approaching something like 75% are foreigners. But even though they're foreigners, when you speak to people here, they have this fantastic belief in the country. You often hear the term, let's do something great for Luxembourg. People feel, as I do, that you can make a change happen and progress a country, which is a fantastic motivator and in terms of a legacy that you may be leaving in your life at some point, that you helped change a country for the better. So everyone does come together. Everyone has great access to each other. The fund management sector, or the fund managers more specifically, let's say, have been a little slower. They've seen less motivation, bearing in mind that, you have obviously a number of large fund managers, investment houses, but an even greater number, a huge multiple number of smaller fund managers that are then using service providers, be it mancos, then downstream administrators, custodians, TAs, etc., to help their business run, whereas they focus just on the investment side of their business. So they've seen less of a driving force, but what we've noticed over the past year, particularly with COVID, is how people have had suddenly seen the risks of a lack of digitalization. For example, silly little things. How do you get a customer signature if you can't meet a customer face to face? How do you send a fax if you're not allowed into the office? Receive a fax if you're not allowed into the office? How do you authenticate somebody's identity without being able to speak to them or physically meet with them? Little things like this have become quite critical in terms of being able to, for business continuity, and therefore digitalization has been the solution. Likewise, on sort of another path, the cost of regulation just continues to go higher and higher and higher, and is really beginning to impact the downstream, the front office and the fund management sector itself. I mean, asset services increasingly have been hit by this. A number of CEOs here have told me how, pre-financial crisis, cost of compliance was maybe sort of between 12 to 15% of their overhead. Now they're talking more in the region of 30 to 40% of their overhead, right? Which is crippling. And the only way to solve these kind of high operational overheads is through automation, digitalization, and efficiency. So, the sector is catching up. A lot of the innovation, as Sharmila has talked about, has been in previous years around payments, around the retail segment, maybe the corporate segment, more front office. But now it's beginning to come into the capital markets industry, the fund management industry, the security industry, because there is a desperate need and there's more competition, more pressure. So digital has to come in to be able to drive this forward. So we are seeing much more engagement now in Luxembourg.
Thank you, Nasir. And I certainly haven't heard faxes mentioned for a while, so that's refreshing. But if I can bring in Sharmil, we've got quite a few questions coming in now from the audience. If I can start throwing a few of these at you, Sharmil, we've got a fund manager in Luxembourg who's asking, how can asset managers employ digitalization to better appeal to millennial investors? A lot of fund managers are thinking through these kind of basic issues.
Sorry, Yuri, can you just repeat the first bit of the question, because you cut out?
Yes, I'm sorry. The Luxembourg is asking, how can asset managers deploy digitalization to better appeal to millennial investors?
Yeah, I think that's it's an interesting question, and it's very topical. So, as you know, my space or my domain is private client asset management, so wealth management. Now, I know there's been a lot of dialogue going on with institutional asset managers, which I imagine are kind of most of your audience and most of your panel members today are being represented by, around D2C offerings. So, I mean, there are some trends at the moment, I guess, which are always appealing to some of the younger demographic. So, whilst I'm not a proponent of buzzwords and the themes of the day, I think certainly an examination of the things that are important to those types of folks is critical. And looking at what's going on in the macro environment, there's been a lot of, as you know, there's been a lot of dialogue. There's been a lot of narrative around activist behaviour. Now, do I think that retail investors, through their behaviour, are going to take down evil hedge funds? No. Do I think that activism can be achieved in a positive way through ESG and ESG related initiatives? Yes. So I think looking at how you deliver services to millennials through that type of lens is probably a good angle, because actually that has more universal appeal. And actually, if we kind of look at asset management overall, eventually, if you are a large company and in a main market index, ESG is being ESG compliant is going to be a default.
Thank you,
Yuri.
And there's a question also come in for Nasir, again from a Luxembourg practitioner who's worried about the future of the dynamic of the industry here. And he's asking, do you think that the future of asset services, the sector which Luxembourg has very much built its reputation on, is the future of this digital only, or will there always be a human need?
No, without any question, there's always a human need, but it's about us adapting to understand how digital can help us be more productive and more effective. Our roles do change over time. Our lives have changed due to digital. I mean, a simple question I often put forward to people is, how many telephone numbers do you remember anymore, right? Because we've got technology such as a mobile phone, we don't remember any telephone numbers anymore. I used to remember everyone's telephone number when I was a kid. It doesn't mean I've become less effective. It doesn't mean my brain has stopped working. It means that I'm using my brain for something else. And there's example after example throughout the industrial revolutions and levels of automation in history that show that it's about adapting to the use of technology. The ATM, the introduction of the ATM was another great one. When ATMs were introduced in the US in the 60s and 70s, everyone thought that was the end of the bank teller. No, it wasn't. There are more bank tellers employed in the US than there ever have been in history, but they do something different, right? So technology is there to assist us. I often say the A in artificial, or what we call artificial intelligence, it can be subdivided into assisted intelligence, augmented intelligence, automated intelligence. Again, all there to help us as humans to continue to be more effective in business. Things are going to become much more streamlined. We should be more focused on the creativity of work rather than on the process and the mundane, as is maybe the case we're doing too much of today. So I think, the industry will progress. And we as humans, as long as we embrace technology and adapt with it, reskill ourselves, and that's critical. We do ourselves have to look at, how do I move forward? We're all going to be fine. I mean, Terminator is not coming to take over the world tomorrow. We're not going to be run by robots, right? We still control. And I lived through this in capital markets, with the revolution in algorithmic and high frequency trading. I became a high frequency trader. Many of the old spot desk manual traders in the FX markets and futures markets, resisted that change. And some of them are taxi drivers now. They didn't adapt and embrace. The one constant in life is change. We can't stop it. So we need to embrace it and go along with the flow.
Nasir, because you are a high frequency trader and you've just admitted to that colourful past, I'm going to put the next question to you as well. Again, from one of our viewers in New York, and they are asking about the unintended consequences of the digitization, the recent events with Reddit, with very fast movement of money into different companies, which some people say distort the markets. Other people say this is democratization, and this is the essence of capital markets. But this guy's saying, can we? We've got these unintended consequences creating bubbles. Can we be sure that more digitization is the answer to all the issues within the industry?
I don't believe it's the answer to all the issues in the industry. I don't believe that at all. There are many, many issues in the industry that will never be solved with digitalization. To me, digitalization is a means to an end in certain sectors. As I said, cost savings. I find it incredible today that people are managing investor databases in Excel spreadsheets. And I know they are. That's a fact, right? I mean, the operational error of being able to process and extract data from that spreadsheet, update that data through manual processes, to me is just pure insanity. And that operational error or that risk carries a cost alongside it, right? I'm astounded at the processes I've seen in institutions around customer authentication and identity. A lot of digital processes can help to resolve that, right? Because these are still largely manual. So in no way am I prescribing that, technology is going to rule the world and save us and solve all our problems like some holy utopia or some blockchain enthusiast may believe it will. I mean, blockchain seems to be the solution to everything in today's world, if you listen to some people. What I believe is, if applied appropriately, can be very effective in reducing costs and ultimately, where we should be focusing the industry, in making more money. But unfortunately, we're still at the side of saving money at the moment, right?
And we have another question from a viewer about COVID. And I'm going to put this one to Sharmila because I know that you're studying the effects of COVID on a lot of different economies, on India, on China, on other economies in Southeast Asia as well. And this viewer is saying, what will be the long-term impact of COVID on the financial services industry and particularly on the digitalization of this industry, its modernization?
COVID's been absolutely horrible. It's been, an unprecedented health crisis at a global level. But I think there are a few silver linings to it all. One is the renewed focus on ESG, and that has become the norm now, I think, going forward from an investment point of view. Second is the huge acceleration in digitalization, and we see it globally. I've told you the numbers for Asia. Like you take India last year, for instance, just to quote numbers. Mobile banking jumped 50% compared to pre-COVID, right? And you've seen tremendous growth across Asia, and it's the other. But the main point I want to make is that it is irreversible. So in Southeast Asia, where Southeast Asia added 40 million users onto the online space alone last year alone, right? And 9 out of 10 of them are like, are surveyed and asked, were like, this is not just a COVID thing. We plan to continue with using digital services and financial services. So it's a trend, and that trend has just been given another lift. So the curve has almost moved up. And there's many benefits to it. You look in terms of access for people who just can't access the financial system through normal channels, and the cost.
Absolutely. And I've got a question on wealth management, and I'll put this one to Sharmil because I know this is an area that you specialize in, particularly its digitization. And this viewer who's a private banker, and she's asking, there are many firms that have adopted e-signature platforms, but they have not updated how they provide evidence of the signer's authority. Authorized signatory management is still manual, paper-based, inefficient, and risky in many firms. Why is this sector so slow to rise to the digital challenge?
Yeah, that's a good question, Yuri. I'll try and give an answer. Although sort of digital signatures isn't necessarily my specific area of expertise. I mean, there has been a history in wealth management of doing things in a very paper-based way, and actually, and this is kind of, I guess, a sort of slightly broader answer to the question. Lots of things that were going on in wealth management, lots of processes that were required in wealth management until relatively recently. A lot of those were paper based, and what's happened as a result of the pandemic is it sort of fast forwarded a lot of these processes by 20 odd years. So look, I think I think there's been in some cases a bit of a sort of slapdash response, as was kind of necessitated by having to go overnight from working in a normal fashion to working from home, and I think some of the more paper-based processes, yes, they've been done away with, but wet signatures, it might be a while till they're a complete thing of the past.
Thank you very much. And Sharmila talked about disenfranchisement and giving the participation in financial services to a greater part of the population. And I wanted to bring in Nasir here. Do you feel there are still many disenfranchised investors for whom asset management can be digitally transformed, made more accessible, and essentially democratized? And which kind of regulations will facilitate this? If I can bring in a sporting analogy, I believe you're a keen cricketer, and I hear there's a very good cricket club which keeps you busy here in Luxembourg. Is this democratization and modernization of asset management perhaps equivalent to adapting the traditional 3-day test match like the one we have going between India and England into the 20 format, more attractive to a younger audience? We can't hear you at the moment, Nasir. Nasir, I can't hear you. Can anybody else hear Nasir at the moment?
No.
No. Can you try again? Nasir, we can't hear you at all. I'm going to have to ask I'll ask one more question to Sharmila. Our ops people say that you're still on mute at the moment. Do you have your phone or the green symbol saying you're on mute? Is it on red? No, we can't hear you. So I'm going to have to. I'll ask Sharmila a question. We'll see. We'll see if we can come back. We're running out of time anyway. So if I'm briefly going to ask you, Sharmila. I know it's a complicated question, but just give me your brief answer, because there's many risks and challenges which policymakers have to deal with. You alluded to regulation earlier on. We've got data privacy, debt bubbles, fintech monopolies. How successful have the regulators in Asia and China in particular been in facing these obstacles when they often appear to have a political dimension? We've seen the authorities trying to rein in the popular and flamboyant business leader Jack Ma and his Ant Financial Services unit. Have the regulators in China gone about this in the right way?
Okay, Yuri, that is a complicated question, so I will try to be brief, but bear with me. So, the first point I'll make is that the regulatory approach governments across South Asia have been quite fragmented, right? And that has had its outcomes as a result of it. But starting with China, now China deliberately has taken a soft touch approach in the initial years of the growth for the last decade, right? If I'm to give you one example, Alipay, it was only in 2011, 8 years after the first Alipay payment went through, that it actually had an official payments license from the central bank. So they've deliberately taken a light approach because they wanted to spur innovation and growth of the financial sector, and it has worked in that. What is unique about China, besides the size of the digital economy, is how integrated it is, right? And now they're changing that, and now they're bringing the whole digital economy, especially the unregulated part of it, into under the regulatory umbrella, and that's what we're seeing with the Ant Group, Tencent, etc., where they're being
So I have
Ant is
to
going
be
to
right. I
become a
have to
pan.
hurry you, Sharmila. Are they
Okay,
going in the right direction?
yeah, they're going in the right direction. In Southeast Asia, and I would include India here, they've been, I would say, they have regulated more right from the start, which, and we could, another time talk about what each country's done, but they've regulated more from the start, and they've adapted, whether it's a standardization of QR codes or, licenses for online banking with very specific licenses. So that's the difference, I would say, between the rest of Asia and China.
Thank you very much, Sharmila. I'm sorry, ladies and gentlemen, our technology let us down slightly in this debate about digitalization, but that's the way it goes. I'd like to thank Sharmil, Nasir, Sharmila for their excellent answers. I'd like to thank you, ladies and gentlemen, for some brilliant questions from the audience, which really livened up our debate today. So digital transformation is just one of the elements of building the asset manager of the future, which will be the topic of our penultimate leaders panel, chaired by my FT colleague from Fundfire, Davidia Thomas, a specialist writer in fund management. This session will begin in 10 minutes. So far, it's goodbye from me and goodbye, Sharmil, Sharmila, and Nasir, and I hope to see you all again soon. Thank you very much.